Hello and welcome to another Smaulgld live stream. Today is Wednesday, October 10th, 2018. Tonight's episode topic is how to make money by losing money. I'm sure you want to know how to figure that out. That's quite a nice trick. Good job if you can get it. We're going to show you how to make money by losing money. But first, let's take a look at what happened in the markets talking about losing money. Dow Jones Industrial Average down 833.83. NASDAQ down 315 points. S&P 500 down 94.66. This meant that the Dow Jones was down 3.1%. NASDAQ down 4%. S&P 500 down 3.29%. Now this creates a big panic. The stock market is down 3%. Now, those of you who are invested in silver or cryptocurrencies know that a 3% drop in the price of silver happens quite often. If you have cryptocurrencies, you know that a 3% drop could happen within a half an hour or 10 minutes. Happens all the time. But speaking of cryptocurrencies, let's take a look at what they did today. Now, today you would be considered a stable day in the crypto world. Bitcoin right now is at 64.90 on Coinbase. That's down 1.43%. In cryptocurrencies, that's no move at all. But in the stock market world, that's half a crash, right? 1.5% plus 1.5% is 3%, and that's what's got everybody all concerned. Bitcoin Cash down 1.6% to 506. Ethereum 222 at 1.61. Litecoin 57.18 down 1.79%. And Ethereum only down 1% at 1072. Now over at gold and silver, let's take a look what happened in gold and silver. Now as you would, last night we looked at the we were looking at the Dow to gold ratio, and we saw there was a big divergence, and I was mentioning last night that for people who trade such things, that was the biggest divergence we've had in years. I think the Dow gold ratio was all the way up to 22. The Dow gold ratio was like 13 to 1. It's now 22 to 1, but it was like 13 to 1 in early 2016. So stock market's gone up a bit and the gold price has gone down. But let's take a look what happened to gold as the losses on Wall Street started to kick in. You can see there was really not much of a change in the gold price, even as the price of shares declined. In fact, at one point, gold was declining with the stock market. By the end of the day, you can see by 1 o'clock, the safe haven bid kicked in and gold started to go higher. So gold opened at 1189 and it gotten down to 1185 and it finally ratcheted its way back up to 1193, and right now it's at 1194. I would have expected a bit more of a follow through on gold in the situation where you have the third largest number decline in the Dow Jones, and you had a 4.08% decrease in the NASDAQ. I still would have thought there'd been a better safe haven bid, but you did see it at the end of the day, and we'll see what happens tomorrow. I guess people don't go rushing for safe havens immediately. We'll see where the stock market goes tomorrow, and we'll see where gold went tomorrow. But it is encouraging to see that you can see that line going straight up. Gold finally caught on. Now, what's also interesting is cryptocurrencies, people say they're safe havens, they're stores of value. They're nothing of the sort. They trade the way they trade. I don't think they trade for any rhyme or reason. And today was no special day one way or the other. It's almost as if there was no stock market decline. Nothing happened. So cryptos are interesting. I also think cryptos are just being manipulated flat while Wall Street figures out when and how to launch their regulated platforms. But that's a different story. We'll cover that another day. But let's finish up with the gold and silver before we get to how to make money by losing money. Let's take a look now at the price of silver today. Now we saw that increase in the gold price. Silver, we didn't see it. Now I'm not surprised about this. because one of my theories and how I look at gold and silver is gold goes first. Gold has to go first. Gold is the go-to metal. No matter what silver pumpers tell you, that's only in the United States, where you have people watching YouTube channels, listen to people pump silver left and right, telling you the gold-silver ratio is unsustainable. It's got to go down to a natural ratio. So many uses for silver. Measure your wealth in silver. All that nonsense. That's only believed in small circles. Globally, silver is not the preferred metal. No one believes that silver is rarer than gold. Gold is by far the more preferred metal and the one that has more monetary value even today than silver. Whatever anyone tells you about silver and they try to tell you it's more valuable than gold, they're just talking their book. Okay, and you can see when there is a problem in the world's financial markets, gold goes higher. Silver is considered, when all else fails, the next best thing. But right now, we're not in all else fails. The stock market went down 3%. Now, that's a big deal, but it's not really. If you see a prolonged decline in the stock market, or you start to see hyperinflation or stagflation, most likely, and this isn't an investment advice, it's just an observation, that gold will probably rise. And silver might not. Now, what we've seen historically is that if gold really starts to catch a bid, then some people start to look at silver and it starts to rise too. But generally, my view is gold has to move first, generally moves first. And in order for silver to have a sustained rally, gold has to have a sustained rally in order for silver to actually catch fire. And since gold has not had a sustained rally since 2011, silver hasn't really had a chance to break out. Now, what did this do to the gold-silver ratio? That unsustainable silver ratio. Well, it didn't really help today that gold did better than silver, and it went all the way up to 83.8 almost. It closed at about 83.5. Nowhere near this nonsense 16-to-1, 7-to-1 natural ratio that they've been pumping for at least a decade now. Complete nonsense, I believe. Now, let's get into tonight's topic, because tonight's topic ties into last night's topic as to why Wall Street wants and needs a crypto bubble. And we're going to approach this from the Austrian School of Economics angle. Now, the Austrian School of Economics believes, and it is probably the best way of analyzing a pure free market economic situation. Because what the Austrian economics starts with its basis is that when you look at Mises or Rothbard, there's a thing called human action, and that people will arrange their affairs in accordance with their self-interest. There's some Ayn Rand stuff in this too, and they will make economic decisions in their best interest. Entrepreneurs and companies will do the same. They will try to meet those desires and needs. And a pure free market, or what's later been called capitalist society, you will get what the consumer wants. And you will get what the consumer wants at the price that the consumer is willing to pay or can pay. And then there'll be competition, and companies will strive to serve that consumer, and that'll drive the price down. That's your pure economic. If there's no intervention, there's no government policies, there's no subsidies, there's no central bank setting interest rates. That's how the world would work. The problem with Austrian economics is they discount, well, they don't discount. They know that there's government intervention, but I think they don't realize how much government intervention is involved. So, for example, Austrian economists will trash the Fed and talk about how the Fed, by setting interest rates, is setting interest rates at an artificial level, which is not a market level. No argument there. They clearly are manipulating interest rates. And one of the theories is that by setting interest rates artificially low, for example, that they're tricking entrepreneurs into making what's called malinvestments. That ones where the entrepreneur goes out, raises money, he's tricked that the interest rates are low because the economy is good, and he makes an investment which isn't going to pay off. And the only reason he made the investment was because The cost of money was cheap. He's tricked. He's gotten what's called a false signal from these artificially low interest rates. So this poor, hapless entrepreneur, the Austrian economic theory goes out and raises his capital, invests in his business or a new business. Now he's out there malinvesting left and right. And he thinks the economy justifies it and his customers are going to come running. But he doesn't realize is that this is just Fed shenanigans. There are no customers on the horizon. He's being tricked by these artificially low interest rates. And then the entrepreneur, who is profit-driven, the assumption that Austrian School of Economics adherents believe in that all business is based on serving customers and then grabbing a profit from serving the customers. Now, that makes sense. You would think if you're going to start a business, that would be what you'd want to do. You would never start a business with how to make money while losing money. You'd be how to make money by making money. That's not just Austrian economics, that's common sense. You would think you're out there, you're going to make your money by making money. You're going to not just grow your revenues, but you're going to grow your profitable revenues. I mean, you can sell more pizza at $4 a pie than you can for $11, but you'd lose $5 a pie. And you can grow your revenues, if you had money to waste, by making sure that you sold as many pizzas as possible at $4. That's economic foolery. You wouldn't do that. You would make more revenue, but you'd lose more money. And you'd have to assume that you'd have the cash to cover all those losses to sell all that pizza. And if you own that business, you would be considered a moron for doing that, unless you had some other alternative motive, like perhaps, well, if we sell everybody pizza for $4, we'll get everybody used to it, and then we'll just raise the price back to $11, and people will continue to buy. Well, what's going to happen when you raise the price to $11? People say pizza wasn't that good. It was good for $4, but there's other pizza out there for $10, $11. There's no reason to come here anymore. So you just lost all that money. So that's why just growing revenues doesn't make sense. You have to make a profit, and that's common sense, you would think. But I'm going to show you how to make money while losing money. And this ties into why Wall Street is going to love cryptocurrencies. Not because cryptocurrencies lose money, but because cryptocurrencies don't even have to make money for them to make money. So they don't even have to learn to trick people anymore to how to make money by losing money. All right, so according to Austrian economics is that if the entrepreneur has been tricked into making a malinvestment, then this is going to end in tears for the entrepreneur because he's been tricked, he borrowed all this money, they gave him a false signal, and it was never justified to invest in his business this way, and it only masked the poor state of the underlying economy, these low rates, and maybe there was an artificial economic boom that was unsustainable, that was created by these artificial rates, and as a result of all this massive investment, not just by this idiot who invested money and malinvested money because of the artificially low interest rates, but because of all the other tricked entrepreneurs. So you got all these entrepreneurs, they don't know what's going on, they see the low interest rates, they go out borrow money, investing in businesses that they think they can make go because the rates are low. But just because you raise rates doesn't mean that you create economic activity. It doesn't mean that there's customers there to buy it. But, I just had another thought there that wasn't included in my original thought. I'll get to that too. So, because of all these entrepreneurs investing money, you look like you get this boom and it's artificial. And then what happens is, they all go bust and the malinvestment is liquidated. And then the economy works again the way it should work, according to Austrian economics. The problem with that theory is that would work if there wasn't further intervention. What the Austrians fail to realize is it's not just the central banks creating artificially low interest rates. That's not the only intervention that happens that actually enables companies that make malinvestments to actually make money. So under the Austrian School of Economics theory is entrepreneurs A, B, and C all see these low interest rates. They get tricked into borrowing money. They invest in their businesses, and then It ends in tears because there wasn't a business there. Boo-hoo for them. But no worries. The investment gets liquidated, and then smarter entrepreneurs take their place and invest more wisely. But we know that's not what happens, because when you've had artificially low interest rates during the housing bubble, what happened at the end of it? Yeah, everyone should have gotten booted out of business for all the stupid investments they made in housing and so on. But that didn't happen. What happened? They were bailed out, and they lowered interest rates even more. But it's even more insidious than that. So where the Austrians also fail to recognize, not only is it government intervention that's going to keep these zombie companies floating and zombie banks floating by central bank intervention, either through the lowering interest rates or direct bailouts. I mean, they'll just hand money to companies and say, stay in business. But also because Wall Street and Silicon Valley or other will continue to promote investments even if they don't make any money. Companies will figure out as an entity that there are ways of making money that don't involve serving customers and making a profit. Now, I've got a couple of companies, and I'll go through them. And again, this isn't investment advice. It's not advice to short companies or to go long on companies. It's an observation on how you have certain companies out there that haven't made a dime, don't make any money, haven't made money for 10, 15, 20 years, and yet have multi-billion-dollar market caps. Say, well, how could that be? Well, the Austrians would say, well, that's malinvestment that has to get liquidated. Well, no, it doesn't get liquidated. It either gets bailed out, subsidized, propped up, either by government subsidy, central bank intervention where they buy their shares and keep the stock price up, or Wall Street manages to pitch the company's shares, even though they're not making money, with some nonsense. So you don't have the market. See, what they always say, well, the market eventually will figure this out. No. What we call the market, incorrectly, is the stock market. That's not the market. That is a rigged collection of traders that is under the protection and auspices of governments, where the Fed, the Swiss National Bank, the Bank of Japan will intervene to buy companies' shares. It's a situation where Wall Street investment banks will promote companies that don't make any money. So let's go through how this happens. So, for example, you would think, under the Austrian School of Economics, that these entrepreneurs, if once they got their lesson, they wouldn't be tricked again. But I would argue they know exactly what's going on. They know that if they can raise capital at the low interest rates, with the right Wall Street backing, the right pedigree, the right investment bank, the right Silicon Valley investor, that they don't have to make money to get their company to go public. There used to be an unwritten rule. You had to have a balance sheet of a certain amount, and you had to have a profit for 3 years before you consider going public. We have companies now on major exchanges that have never made any money. In fact, probably never will. They don't need to. And so that means that entrepreneurs aren't tricked. They love the low interest environment. Not only do they know that they can move into a situation where they'll get backed by Silicon Valley, they'll get public by Wall Street, they can do secondary offerings, and then they also know if they want to boost the stock price, they don't have to do any better. They know that the artificially low interest rates means they can borrow money and do stock buybacks. So let me give you an example. I mean, you can think of Tesla. You can think of what other companies we got out there. You got Tesla. You got Pandora. You have Spotify. Spotify has a market cap of $27.5 billion and it loses like $10 a share. Pandora is worth like $3 billion. This is just to stream music. Now, how do they get those market caps? If those companies were out there with their own money, running the company, trying to make a profit, and they didn't, they'd be out of business because they'd run out of money. But here's what they do. Tesla's worth $45 billion. It used to be worth like 60 or 70 or 80. I mean, again, this is an investment advice, not advice to short or long any of these companies. It's just that they don't make any money, which would be inconceivable 20, 30 years ago, that they would have any market cap. I mean, there's nothing there. You know, and people will argue with, oh, but Tesla this, they're going to do that. Yeah, but they've been going to do stuff for 10 years, and I haven't done anything. They make a limited number of cars. In fact, the people who have them, there's been problems with the cars. But let's take a look at a company, because I had done a blog post on this a while back called Zillow. And Zillow sells real estate advertising and real estate information to the public. They don't sell it to the public. They give real estate information, and they hope, therefore, they can get advertised money because people visit the site. Okay. So Zillow was founded in 2005 and has raised $528 million. They raised $500 million. Not all at once. They did the normal thing that companies do. They raised $87 million prior to going public. And over the last 10 years or so, 15 years, they've generated $1 billion in revenues and about $300 million in losses. Okay, they went public, in 2011, so they had 6 years in the wilderness trying to live off of their $87 million. But then they hit pay dirt. They go public, and they get a market cap of about $700 million. Well, that market cap right now is worth about $8 billion. They still don't make any money. They've never made any money, and they probably never will, but they don't have to. And here's why. They are able to continue, or were able to continue from 2005 to 2013 to raise capital. Let me show you a chart, what I'm talking about on how they did it. So this chart shows the capital raising that they did starting in 2005. So before they went public, they raised that $87 million, and they did that in what they call tranches, 3 tranches. 2005, they raised $32 million. 2006, $25 million. Then in 2007, they raised $30 million, and that lasts them to 2011, when finally they're almost out of money from whatever they're doing to get themselves ready to go public, trying to gain customer base, footprint, visitors, and so on. Technology team. They raised $80 million, or $79,626,000 in their first public offering, and then they also dish out about $5.5 million in a private placement. Well, now they had $80 million, and about a year later they come back and they figure they need another $150 million. Now, that's not because they're making money. No, they need to raise more money because they're running out of the first tranche of $80 million. Now they got $150 million more. They raised $147 million plus $4 million in 2012. And then in 2013, they do another offering. And why are they doing these offerings? Because Wall Street is able to convince the public that this company's got a future. This company's got it going on. It's moving on up. And is it making more money? No. But it has potential. It's in the hottest space, and it's got eyeballs, and everybody's heard of Zillow, and so, okay, what's my home worth and all that stuff. But let's take a look at how the company was doing. They were growing revenues, but as they grew their revenues, surprisingly enough, they also grew their losses. But who cares? Company's moving up. The company's now got $500 million in capital, so they can afford to lose $10, $15, $20 million a year for 15 years if they want. And they know that they don't have to do that because they can always raise more money. So basically you get these companies that investors get comfortable with, not looking at the profit, just looking at the revenue. And look, they got a nice job on the revenue there. I didn't fill out the chart since then, but I'm sure it's the same thing. They continue to drive their revenue. But they're not driving profitable revenue. They're driving revenue that, all right, so it's like my pizza example. You could sell more pizzas at $4 than you can at $11, but you also lose money on each pizza pie you sell. That's the old joke, but don't worry about it. We make it up in volume. That used to be a joke, but this is actually the way you make money by losing money. Now, what I had done at one point, I had shown how not only, well, you said, well, how does the company benefit from the stock price going up? Well, The CEO of Zillow from 2011 to 2016, he sold $70 million worth of his shares. So it all paid off for him. Now, normally you would think that that a CEO is rewarded for steering his or her company to profitability. After all, that's why companies exist, right? Because if they make a profit, then everybody wins because profits can be paid out. You can give out dividends. You can reinvest in the business. But in this kind of game that you have going on Wall Street is all you have to do is make the stock price go higher. And if the stock price goes higher, you are a successful CEO. You are a successful member of the management team. You managed to make the company not make money, but you managed to make the company make stock gains. And if you can do that, that's far better and far more in demand on Wall Street than actually a company that's making profits. So the Zillow CEO would sell his shares every year. You know, they do this on a, I think they do it on a way where they don't even have to make a decision to sell. There's some type of SEC rule which allows you just to get your stock options and then put them on an automatic program so that therefore they get sold without you making a decision, so you can't be held liable for insider trading. So you just start selling them, and if they're in the money, you sell them, and people at Zillow made a lot of money. But the question is, and I'm not picking on Zillow because there's many companies like it. I just happen to have gone through their financials. But you have other companies that are in exactly the same position. And what they do is they make money by losing money, by growing revenues or growing a user base or whatever. And now that leads us to what I was talking about last night, why Wall Street loves this kind of stuff. At some point, one would say that, okay, and maybe it's not, you know, I think at some point you would say a company has to make a profit for it to continue to have its market capitalization. And we saw that with .com when it became .bomb. So in Barron's, they wrote in 2000, what's with these companies? They don't make any money. And people collectively woke up and said, why do I have this company, Pets.com, Van.com, whatever it was? They're not going to make any money. So they sold them. Well, it seems now, I would have thought they never would have been able to pull it off again just a few short years later to bring back these other companies, social media companies, Tesla, Spotify, all these companies that don't, you know, FANGs companies, or worse, what they call unicorn stocks that don't make any money at all, that they'd be able to pump these back into the system. But they seem to have perfected it to a science where you can bring companies public, they can stay public, they can raise money, they can raise more money, and they can fund their losses through investors willing to invest in companies that don't make money. Why? They grow the revenue, or for whatever metric, they got more users, more eyeballs, more brand recognition, whatever it is, they're willing to bid these things higher. Now, I always looked at a company, if it had a PE of 20, it'd say, well, if I had the $500 million it would cost to buy that company at 20 times earnings, it would make sense because over 20 years, I'd make all my money back, assuming that it stayed at that price, and then I'd still own the company, so that'd be a good deal. But if it doesn't have a PE, why would you buy a company? Like, so for example, in the case like Tesla or Zillow or whatever, why would you pay $8 billion for the company? You're not going to be able to live off of the income. In fact, you're going to have to fund its losses. You say, well, it's got $200 million in cash. Okay, but you're going to pay $8 billion for the 200, I'm making these numbers up, for 200 million in cash. I'm just guessing it's about what they have now. Maybe they have less, maybe they have more. But assuming they have the most that they ever raised, which we know they don't because they spent a lot of it. So why would you pay $8 billion for 200 million in cash and a company that loses money? Well, because you can eventually make that company turn into money. It's going to generate revenue, you can get profits, and then you can pull that money out of the company. No, you can't, because they have no plan to be profitable. The way these companies make money is by continuing to sell the dream to somebody else that the stock price should be worth higher. You would never, that's why I didn't understand when I knew it was impossible when Elon Musk said he was going to take the company public at $420. I thought, who would want it? What are they going to do with it? Because that would mean they'd be paying $60 billion for it. How are they going to get their money back out of that? Now, Dell, I think, when they went private, they looked at it and they said, well, the PE is low. And if we manage this and we don't have to all the expenses of being a public company and filing and lawyers and all that stuff, we might be able to pull out enough money where we might make a 10-15% return a year on it. And that's pretty good in this environment. So companies get taken public when it makes sense because the stock price doesn't reflect its value. But for Tesla to think that a $400 or $63 billion market cap didn't reflect the value, I'd say under what criteria do you have that would say that Tesla's worth $63 billion? Not on revenue, not on profits, not on any projections. It's all based on pie in the sky. Okay, enough beating a dead horse on how Wall Street manages to boost these companies higher. And it's not just Wall Street. You know, when the Swiss National Bank owns Tesla, they own Zillow, it means that they're all part of it. This isn't a real market. A real market, you would never have a company who has no plans of making money, never has made any money, that would have multi-billion-dollar market caps. The only reason they have multi-billion-dollar market caps is because it's not really a capitalist free market market. It's really a controlled market by Wall Street and central banks and big players who tell you this is what you're buying. And of course, everyone wants to buy what everybody else is buying. So they put out, you know, strong buys on this, and the central banks buy it. Wall Street buys it, convince other institutional investors to buy it, and they go higher. All right. But underneath it, they must know, maybe they don't. If you're under 30, you think this is normal. You think these are companies that are worth whatever they're worth because that's what they're worth, and in a way they're right, but they're not worth anything on the basis of profit and loss. So a nagging thought must hit the bankers when they see, you know, it's going to be hard to continue to boost these companies. You know, maybe we can boost them not on profit but on revenue, but maybe at some point the revenue growth slows down, and how do we keep boosting them higher? And maybe we're seeing that's collapsing right now, maybe not. They'll just pump more money into it after today's, and the stock prices will go back up. But there is a risk that people are going to start to doubt the valuations like they did back in the dot-com period, where they said, whoa, why do we have these companies? Maybe at some point people wake up and say, why is Spotify worth $28 billion? Why is Tesla worth $46 billion, 30, whatever it's worth now? Again, not investment advice. I'm just talking in macro here. But I think the bankers realize that. So they need something to either, if they can continue to boost them, they want to move some of these assets into cryptocurrencies, which appear not to have any correlation whatsoever to the stock market, which is beautiful for them because if the stock market crashes, they're unaffected. They just do whatever they're going to do. But also because if you move money into cryptocurrencies, you don't have to worry about stock valuations. You don't have to worry about profits. They don't have any. They're just there, and you just convince people they're worth a lot. Now, they've already managed to convince people that these companies, these FANGs, these unicorns, these other companies that don't make any money, that they're worth something. But people like maybe you and me, we might say, well, what about the profit? And there might be enough people out there nagging them about the profits. Well, there's no nagging on Bitcoin. Bitcoin doesn't make a profit. It's not supposed to make a profit. Doesn't make a profit. That could be a cut against it, but it also could be, yeah, but everybody wants it. Why does everybody want it? Because everybody wants it, and Wall Street's selling it. They love that. That's what I don't think people understand about why I think that the bankers they're not threatened by Bitcoin or Litecoin or all that stuff. Yeah, maybe they are, but I don't think they see the big threat. I think what they really see is an opportunity. Look, here's something Bloomberg had today. Elon Musk has 143 days before creditors start demanding their money. I would think that company wouldn't be worth it, but Wall Street doesn't care. Probably because they know they can arrange financing somehow. You know, people who people trash these types of companies. Oh, it's unsustainable. Nonsense. It's very sustainable. We've seen these companies out there for 5, 10, 15 years continuing to grow their market caps. And what it comes down to is because it's not a free market. Tesla shouldn't be worth billions, but it is. Why? Because it's not in a free market. It's on Wall Street. It's subsidized. It's in the game. You know, it's the same thing when people say, when they look at modern art or Jackson Pollock or whoever, and you see that the price of a painting goes for $48 million, $139 million, and you know all these armchair art critics or financial critics on Twitter, oh, it's not worth anything, it's garbage, it's just a bubble. It doesn't matter what you think. The only market that matters are the people that control that market. And for example, in the art market, there's not a lot of players. You don't participate. If you don't participate in the art market, your opinion means nothing. You could say Jackson Pollock's a bunch of bullocks. It's just a bunch of splatters. And I could agree with you. That doesn't detract from its value. You're not in there bidding on paintings. You have no. The fact that you don't like the painting is irrelevant to the person who wants to pay $287 million for it. It's the same with Bitcoin. It's people, oh, Bitcoin's going to 0. It's going to 200. It's going, oh, who the hell wants Bitcoin? You don't. That's all that means is you don't want it. But if there's enough people that want it, it goes higher. And if Wall Street wants it to go higher, they can make it go higher. That's my only point. And that means that the markets are not full and free where everybody participates. If you're not in a market, you can have an opinion on it, but your opinion is irrelevant. What you think of Jackson Pollock, what you think of Bitcoin, or even what you think of Zillow. Now, and in the stock market, what you think of Zillow or Tesla could matter because you could short the stock. But of course, we've seen what they can do to get around the shorts. They can manipulate, and the SEC will allow it. He comes out and says, oh, price is $300, $80. Well, it's going to be $420 because I'm taking it public. Boom. All right, so that's what we're seeing happening, and we're seeing a lot of money move into the crypto space. And again, here, Singapore moves to help crypto startups receive banking services. All part of my thesis that the banks aren't against this. They want to integrate the cryptocurrencies into the payment systems and thereby control them. They want to get trading fees. They want to get derivative fees. They want to get ETF fees. Big, big money. And the best thing about it is they don't have to promote companies that don't make money. They don't have to promote them as this or that. They just have to promote them as being crypto and whatever nonsense they want to say about them, how wonderful they are. And they'll get away with it. They've already proven they can pump stocks that don't make any money into the billions. Again, 30 years ago, you couldn't find a stock on a stock exchange that lost money for the last 5 years and was still listed. It'd be gone. But today, a good portion of these stocks, I'm not saying they're not stocks on the stock exchange that don't make money, but there are a large number of companies that don't make any money that have ridiculous market caps, billions and billions. And if they can do that to that, if they can pull off that trick and make money from companies that lose money, clearly they can make it off of cryptos because cryptos don't make or lose money. Now, eventually what they'll do is they'll start issuing registered ICOs, and they'll make them so far removed from whatever company they're supposed to be associated with that they won't be bought on the basis of them having a profit. They'll be sold on the basis that they're cryptos. Remember, like .blockchain or whatever you want to add to this stuff. So I wanted to get that out there because a lot of people follow the Austrian School of Economics, as do I. And the Austrian School of Economics will have you believe everything is fake. Everything is a result of government intervention. Malinvestment eventually gets liquidated. Well, no, it doesn't. It just gets bailed out. And therefore, buy gold. In a world where you had a free market economy, that would be true. We don't. They have complete control over these markets, which again are not the economy. And there's a big disconnect between what happens on them. A company that doesn't make money should not go up in price. That means there's a disconnect between Wall Street and Main Street, but that disconnect is intentional and it's supported by Wall Street, Silicon Valley, and central banks. They love it. They love it. They love it. All right, let's see what we got by way of comments here. Let's see. I want to get this ugly chart off of here. I want to get into something that's nicer looking for you to look at while we're chatting and while I'm checking out the comments. So you know what I'm going to show you, of course. I'm going to show you a stable of mugs, maybe. Maybe I show you the Smaulgld mugs because they are the best. There's Smaulgld mugs. There we go. Classic and super classic mug. Okay, let's take a look at our comments. Good evening, says Tom Manley. Good to have you, Tom. Bogus Fiat checking in. He checks in a lot. Good to see you again. Well, I have to agree with the cryptos being held flat until they figure out what they want to do to this stuff and control it. If you look at the chart, Tom, it's been flat for like 6-7 weeks. And we know that Bakkt, that Microsoft New York Stock Exchange company, is supposed to go live in November. We know that they're thinking about getting maybe this November 9 Bitcoin ETFs lined up. they can't have the price running away from them, because then if they bring these products to the market when the price has gone from 6,000 to 20,000, there might not be that much interest. Also, if the price goes from 6,000 to 2,000, there might not be that much interest. But the best thing for them is to have, look, it's at $6,000. It's been sitting there. It's a steal because it used to be $20,000. It's at the perfect level. Because if it goes lower, then it's like, well, that's because no one wants it. They don't want that concept, but they also want it to be too high. And then they want to be able to say, see what we did for our clients? We got them into cryptos. We got them into Bitcoin at 6,200, and it's now at 9,000. That's a bigger return than the stock market. That's just my, again, not investment advice. That's my semi-prediction of what's going on. Could be, as they say in England, bullocks, but that's what I believe. And in the distance, a distinct clattering of mugs. Smaulgld mugs is not me. Federal Reserve sucks. Okay, so Silverine. Where's Barry? Amazon took a while to make a profit. But yeah, all these stocks are dog. Beep. Yeah, I've always looked at Amazon, and one of the things when I analyzed Amazon was Amazon I did see as valuable, and that they could make money one day. And what Amazon did, which was, I thought, a valuable thing, which was build up a customer base, build up customer preferences, build out supply lines, build out distributors, build out warehouses, and have something there that you could deliver a product to the market and meet consumer demand and do it better than anyone else. And so there I can see Amazon having a large market cap to grow into, that they then can make profits, and that they went into different lines. They can move into more profitable lines, like not just books. Books never made much sense because you don't make that much money on books as you can make on other products. Then they got into digital downloads. So I don't hold Amazon in the same disregard as I do some of these other stocks. I can almost see that might be an exception where you say, well, look, they really are going to be the global leader in retail. All right. The free market is a fairy tale. That's right, Walden Tree. That's the point. When Austrian School of Economics act like, well, the free market's out there and it'll eventually take over. No, it won't. Not if the free market is a closed system, which is the whole Wall Street game. Because who picks which companies go public? Who picks which ones get boosted? You know, it's not just the fact that the Federal Reserve lowers interest rates and eventually the market will fix that for it. It won't. What every man should have. Where else can you get this level of analysis with this perspective? I don't know. Let me know if you find something else. I'd like to have you know where you can get it. You get it here, and you get it from the people that listen, and they come on the Smaulgld subscribers sound off. Michael Perez, Austin, Texas is the house. I got some silver and gold for sale. Back your dollar with real money. Why would you do that? You could make more, quote, money not backing it. That's what people don't understand is they keep saying gold, back yuan, game changer. Last thing China wants to do is back the yuan with gold. They're in a massive credit creation right now. That's how they managed to move 400 million Chinese from the country into the city. They didn't do it by being prudent. They did it by borrowing money, building stuff they didn't need, selling products to the United States for lower than cost of production, paying people nothing. It's all credit driven. Credit. And people can argue credit is evil, and I wouldn't disagree. And sound money is better, but they do manage to generate real economic activity with credit. What credit does is it brings demand forward. It allows people to spend money they don't otherwise have, to consume now, and even in a sense to produce now for that which they don't need. That's what a ghost city is. You build cities that you don't need and they understand you might need them. You may never need them, which means that's a malinvestment and the thing just collapses. But you got people to work for a while. It's better than digging ditches and filling them back up, but it's the same thing. It's just high tech or more advanced digging ditches and filling them back up and borrowing money to do it. Walden Tree, the financial oligarchy creates money and shares out amongst their buddies effectively, meanwhile screwing the little guy. That's absolutely true. That's exactly what QE is. That's exactly what low interest rates are. That's exactly what any company that goes public. And you can blame Silicon Valley for this. And you can blame the whole Silicon Valley companies. They don't make any money, which means anybody working for them isn't really doing any valuable work. The company doesn't make any money. And yet, you see executives making 50 million, 80 million, 100 million, secondary level executives making $10, $15 million. And that's why they're able to pay $7, $8 million, $2 million, $3 million for a house in San Francisco. Because they're making millions of dollars. Not because the company's making millions of dollars, but because their stock prices are higher. All right, let's see what else Michael Perez says. Be brave, take control back, support your local economy. Well, that's true. You know, you support your local economy. You know, what's interesting is some of your local shops make more money. Well, they make more money than Tesla does. Think about that. They make more money than companies that are worth 8, 10, 12, 15, 40 billion dollars. Unbelievable. Cryptos go to zero and the lights go out. Yeah, everything goes to zero when the lights go out, but what happens when the lights go back on? I mean, are the lights going to go out forever? So if you think the lights are going to go out, then you should prep. Nothing wrong with that. But does that mean that while you're prepping, you don't take advantage of other opportunities when the lights are on? It's kind of foolish to bet on the lights going out. It's not foolish. It's smart to prepare. But once you're prepared, you should have the assumption that the lights aren't going to go out and that your prepping is insurance, not a bet on disaster. But that's how I look at it. Wait a minute. Not me says, growing up, we got trophies just for showing up. Now you're saying what we think doesn't matter? I have to take my therapy, go to my safe space. Yes, you do need to have a safe space. And I was wondering if Smaulgld could create one online, kind of a digital safe space somewhere where people get offended by what I say. They can go into the safe space and just chill out for a while. Anyway, I want to thank everyone for listening. I know tonight was a little tough going. It's different concepts than just explaining why gold and silver aren't set to skyrocket. But that's the story for tonight. And, oh, got another comment before I sign off. By the way, if you want to buy gold or silver, before I take that last comment, please do so through the Smaulgld site. You can buy through SD Bullion, Money Metals Exchange, Golden Eagle Coins. There's the SD Bullion link there. Smaulgld gets a small commission. You pay no more nor less than you visit those sites directly. Not investment advice to buy gold or silver. If you're going to, please help support the site by buying through the Smaulgld links. And also you could support the site, even though actually I lose it. This is bad economics for me. Actually lose $1 per mug after the shipping, but that's all right. It's good marketing. You buy a Smaulgld mug. I do make money when you buy from the Smaulgld store, however. The Smaulgld products there, I built in a small margin. You can buy some Smaulgld related products there. Or you can help out the site by becoming a Smaulgld patron. You be my buddy that way. We can chat offline or outside of these things there. And also, you can donate via PayPal. You can donate Bitcoin. There's a whole bunch of ways you can help the site out, and I do appreciate that. All right, let's get back to, I'll leave you all those links right now. There they are. All right, let's get into the last final comments here. Michael Perez had a blast. Good night. Well, I enjoyed myself too. Thanks for joining me, Shark Air. I thought I was treating my baby fair. Now she's getting in my hair. Boom, boom. Out go the lights. All right. Sounds like Pat Travers. Oh, Dan R. Agree or disagree? The market correction is from the Fed and attempt to affect the midterm. Sorry if you discussed already. No, I didn't discuss that, and that's a matter of speculation. So, one can argue that these things just happen. That's possibility number one. Price can only go for so long. Number two is, back in September, after the Fed's meeting, they said they're going to continue to raise interest rates. You know, there are times where at some point the light goes off and say, wait a minute, the Fed has raised rates. It's now at 2% interest rates. The rest of the world has interest rates at, what, 0, negative interest rates. So you get to the point where sometimes there's a confluence of events, and no one knows if it's actually the market understanding all this at once or it's just the explanation of it afterwards. But we did see today some inflation numbers going higher. We saw the Dallas Fed president say that that he foresees 3 more interest rate hikes. You know, interest rate hikes are not good for the stock market. I mean, if you're getting a 3.2 or a 3.4 return on the U.S. 10-year, the U.S. 30-year, you might be better off there than buying stock markets who have valuations which are really stretched or have companies out there that don't have any PEs, they have no earnings. So maybe some fund managers are thinking, look, they're raising rates, the rates are high, market could be set to go down. Maybe I should lighten up a bit here. Maybe I should buy some treasury bonds. Maybe I should buy a little gold. Maybe I should reduce my positions. So that could be it. Also, Trump has been saying for months now, he doesn't like the fact that the Fed is raising interest rates. They've raised them 7 times since he became president. Obama only had 1 interest rate in 2015. And the Fed is basically saying, oh no, we're independent. We're going to keep raising rates. And, you know, so that could have something to do with why people are lightening up. And we don't know where this is going to go. This could be just today. We could see some follow through tomorrow. I mean, we had the producer price index today at 0.2. It's not tremendously inflationary, but, you know, we could get hit with some inflation. Some people are concerned about what's happening with China. Maybe this trade war won't just be, quote, as Trump says, easy to win. Maybe it's going to take longer. You know, the longer that the United States tariffs these Chinese products, the more it's going to start affecting consumer products, and that's going to lead to inflation. We see Ford and automobiles, they're down. So as interest rates rise, it's hard to give out those loans to sell cars for cheap. The real estate market could start to get hit. Rising interest rates are never good for the economy, and they generally have a lag effect. They take longer to affect, and so maybe they're just starting to hit. People are finally waking up and saying, you know, it's an interest rate lag. So I don't know if there was any direct intervention today to crash the market. Now, it would be helpful for the deep state, you would think, that, you know, people like Bill Maher says, you know, if the best thing that can happen is a recession, that's how we get rid of Trump. As we've seen, a lot of the economy is based on the stock market, and Trump has been touting that. Now, one of the things I had predicted, you guys might not know this, I was on the X22 report way back in 2016, and I've been on there a few times. I don't know which the name of the episode was, but what I said back then was, what Trump might do if he can keep the stock market higher, that a lot of his enemies are dependent on the stock market. Where's all that money? Wall Street, Silicon Valley, Google, Facebook, Apple. They're the companies that have the inflated IPO stock market prices. That if he got the economy going to the point where he had what I call regular workers, factory workers, steel workers, they would care less about the stock market going down. And it would hurt the people that had money in the stock market. And I would venture a guess that the wealthiest people, the ones with the stocks, for the large majority, are Democrats. Just a theory I had that he may want a stock market correction right around the time of the election, because I think he might think it doesn't hurt his people. I don't know. That's just a theory, but we'll have to see what happens. But again, I don't know if that's what's happening right now. It might work out to, if they want to take Trump out, to crash the stock market on him. But then again, he has the capability through the plunge protection team, the exchange stabilization fund, to direct and order monies back into the stock market. Plunge protection team was set up. It was called the Presidential's Working Group on Financial Markets, set up in 1987 after the stock market crash, and the president's in charge of it. So he can direct either private companies to come up with a solution to boost the prices, or he can direct money directly from the Treasury. So we'll see how that goes. I'm not quite sure that there's forces out there that can collapse the stock market to make him look bad. All right, let's see what else we got before I call it a night. I don't want to leave anyone hanging now. So that was Dan R's correction. Dr. Medesco Esquire says, boom, boom, out go the lights. It was Pat Travers then. Okay. That's what I thought it was. Oh, we got more questions here. Whoa. Okay. Trump appointed Powell, so he's got no one to blame but himself. Yeah, you know, if you go through, there's a nice book for you guys to read inside the Nixon administration. It's called The Secret Diary of Arthur Burns. And it talks about Arthur Burns was selected by Nixon, and Nixon selected him in 1969, 1970 for the purposes of having loose monetary policy. So when he came around in 1972 to get reelected, he wouldn't have to worry about the economy. And Arthur Burns had different ideas. He thought the Fed was independent. And Nixon took him into the office, and I think he yelled at him, told him, what the hell are you doing? And that's effectively what Trump is doing to Powell. The Fed has been very good at trying to keep, their independence. And if they have to raise rates just to prove their independence, I think they will. It's kabuki and Trump's in on. Well, that's another theory people have, is that Trump's in on all this. I think that it's a bit too much to think that, but it's possible. Anything is possible. I don't know how the ins and outs of this stuff. I was listening into After the Bell on CNBC, and someone mentioned, says Dan R, that this could be health 5-day bull market, which did not happen since April. Okay. Dr. Benesco, Esquire, men play women in kabuki. Signs of the times. Well, men play women in Monty Python too. Oh, he's going to bed yet. Oh, yes he does. Right? You know that? It's Monty Python. What is the one where they're... Well, I can't say it because there's some nasty words in that skit, but I could do it. Monty Python females. All right. Secretly hoping this is the one. We're in the longest bull market in 10 years. What should we be watching for tomorrow? The market. More plummeting? Who knows? Hope so. Let's see. Steve Hall. Where was the Fed today? What was the point buying? What was the plunge protection team buying? I don't know, mate. They don't always buy. I mean... They don't buy until they see there's a problem. I mean, I think it was Kudlow on today said this is healthy. I guess it's true in a real market. If it's just blowing off steam, it's fine. Who knows? History shows, says Dan R, interest rates is good or bad for the PM market, gold or silver. You never know. It depends on other, not just interest rates. But rising interest rates are generally not good for the stock market, that's for sure. For gold and silver, it's more a function of real interest rates, is where they are versus inflation. Yep, stratospheric interest rates in the early 80s and gold was going straight into the tank. That's true. Anyone doubting precious metals does not understand. No, you see, I think people who believe only in precious metals don't understand, because they have been indoctrinated into one point of view. Gold is money, period. They have a point of view where the rest of the world doesn't matter. The rest of the world's out of step, and only gold and silver. If you only spend time with people who believe that, then you'd be right. But the problem is 99% of the world doesn't believe it. So this idea that the world always returns to gold and silver. Gold has been money for 5,000 years. That's akin to saying horses have been transportation for 5,000 years. Period. That's it. It's always going to be that way. And if you don't know that, you don't know your financial history. I've heard all that. I know more about gold and silver than most people. I know more about Austrian economics. The point is, just knowing stuff and being indoctrinated in dogma doesn't mean you know anything. It just means you're aware of a point of view and you just adopt it. What I do here, I don't adopt points of view. I don't listen to a particular person. I don't listen to a particular school, ingest the dogma, and assume that it's always right. And anyone who disagrees is a moron or a shill. No, I really try to keep an open mind and everything. And when I hear dogma, I can spot it, and I try not to be dogmatic myself. Safe space, anyone. All right, steel industry is coining money with tariffs and no pay increase for the steelworkers union members. Yep. Who is this guy? Steve Hall, what guy? Smaulgld. He just appeared on my feed. What song is to start? You see, here's what happened. I think Steve Hall is a classic example. And there's a guy named Mark Battaglia. He once heard me and he was like, who is this guy? He's driving me nuts. He doesn't believe in the game over, game changer, COMEX default, silver shortage, silver set to skyrocket, dollar collapse. I don't believe in any of that nonsense. And he thought, oh, get this guy off my screen. Why did he think that? He doesn't think that anymore. He actually came up with a concept that I was the red pill for the red pilled. You go through this indoctrination about listening to all these gold and silver pumpers, and you believe it. But you know what? I started thinking after about five years ago, well, how come they're wrong? And there's reasons they're wrong, because they won't let go of their original concepts. That gold and silver are money, period. Gold and silver are set to skyrocket. COMEX is set to default. Dollar is gonna collapse. End of dollar hegemony. Game over. Game changer. They keep repeating themselves, and they're not analyzing what else has happened. I'm not even going to go through, I mean, there's a whole lot of stuff I can talk about on that. The point is that when people have been indoctrinated into listening to this kind of stuff, They get offended when they hear something that challenges it. Now, it's offensive to listen to someone who's challenging it and they don't know any better. I do know better. I've heard all this stuff. I believed all this stuff myself. But I've researched far more than just listening to the dogma. And that's why people get annoyed. All right, when interest rates are high in the U.S., you can borrow yen to buy bonds and pay interest. Gold does not pay interest, so raising interest rates can be detrimental to gold for a point. Very good point, Shark here. That is the cut against gold, that it doesn't pay interest. Now, it's not supposed to, and it's not supposed to increase in value. The advantages of gold are the disadvantages of the gold. It's inert, and it doesn't do anything. That's a good thing. Can't make any mistakes. It can't default. Remember, anytime someone pays interest, they can default on that interest. Which means gold is good because it doesn't pay interest. Gold can't default. Gold can't tell you to go pound sand, you're not getting paid. Gold can't tell you, how about I pay you next week? How about I pay you 3 months from now? How about we convert it into some type of derivative security? No. Gold is gold and that's it. You got your gold. You got an ounce of gold, you got an ounce of gold. And that's what Buffett says is a problem. Oh, you take an ounce of gold and you bury it and you come back and get it, it's still an ounce of gold. Yeah, you moron. That's what it's supposed to be. It's not supposed to grow. Now, if you want growth and you want the ability to influence people and to subsidize people and to bail out people, you can't do that to gold. That's why Buffett doesn't like it. Because he can make more money by human activity, which he can help direct. So gold is not supposed to be paying interest. It's not supposed to earn a dividend. It's not supposed to do anything. It's there. It's the anti-stock or bond. While stocks and bonds can go higher or pay interest, they can also totally screw up and go bankrupt. Okay, the main reason they were wrong was no sane person would have expected the suicidal behavior of QE. Okay, QE ended when? First of all, the same people that were saying that, they were saying there's no way the Fed could raise interest rates. The Fed could never raise interest rates. You go back to my article in 2015, I said, BS. Yes, they will raise interest rates. They'll continue to raise interest rates, and here's why. All the gold pumpers say, they never can raise interest rates. It's impossible. They'll never raise them. You see, they like to excuse everything with it was QE. First of all, QE has been over for years, and gold hasn't gone any higher. There's so many more things at play, they refuse to look at them. They're still living in 2008. And I think that's why they get it wrong. A person familiar with Japan's fiscal policy would have expected QE. Yeah, and Peter Schiff, to his credit, did expect them to do this, but he didn't expect the result. He thought, and he was right, the first two QEs, if you look what happened, the first two QEs led everyone into, this is screwed up. Stock market didn't rise, real estate didn't rise, but gold and silver did. Because people were like, this is messed up. This is totally debasing the dollar. And then when they did QE, my reaction was, holy beep, this is unbelievable. That's when I thought we were off to the races. I thought, I can't believe this third QE is bigger and better than ever. And gold and silver fell. That was shocking. And eventually, the stock market started to rise, real estate started to rise, and we've been there ever since. And then they stopped QEing. And no one thought, not only could they raise interest rates, they couldn't shrink the balance sheet. They've done a lot more than they've expected them. And they're still living in, I think, 2008, 2010 with their analysis. They haven't moved on from that. They haven't seen what I talked about earlier, the extent at which these markets are controlled. They're not markets. And you know, Gaddis says this. They say there are no markets, there's just interventions. And they're right. Yet they still hold hope out for higher prices, even though they have documented these manipulations. I mean, it doesn't make any sense to make predictions. Gold and silver set to skyrocket, and when they don't, they say, well, it's manipulation. Well, you know about manipulation. You're the ones always talking about, not Gaddis, but just anyone in general. They're talking about how they naked short sell. All these things, they know all about this. Then why do they expect this time to be different? All right. Debt monetization ongoing. Yes, Steve. Oh, in America's multi-continent. All right. All right. I think that's it. Oh, there's Pablo Pina. Okay. Good to see you. All right, everyone. Thank you very much for listening. And we'll be here again tomorrow night, 8 o'clock Eastern Standard Time, maybe 8:30. and we'll see you tomorrow.